Good morning, everyone. We're going to try to get started with the first panel now. Okay, we're gonna get started.
Class.
Thank you. So the first panel this morning is on perspectives on housing risk, but let me just comment a little bit more about what we're going to do up here. So yesterday we had, I thought, an exceptionally interesting set of presentations and discussions that covered an enormous amount of territory, ranging from mortgage risks to housing risks to long historical perspectives on housing policy, information available to consumers, new mortgage products, and an international perspective. It was a bit mind-boggling. So what I've asked our panelists to do here is to each offer some comments on how they would distill some of the discussion and presentations from yesterday in light of their own substantial expertise in research. So without further ado, let me just introduce the three panelists very briefly, and we'll get started. The first is Steve Malpezzi from University of Wisconsin. Steve's a professor in the Graskamp Center for Real Estate. Joe Tracy, who is at the New York Fed, was research director at the New York Fed, now is an executive vice president and a special advisor to the president of the bank. And finally, Alan Weiss, who is CEO of Weiss Residential Research and former CEO and co-founder of Case-Shiller Weiss, which of course developed the S&P Case-Shiller House Price Indexes. So very distinguished panel, happy to have them with us. We're going to start with each giving an initial presentation of up to 10 minutes. There's not a requirement to use every second. And then we'll go to a little bit of discussion among the panelists and open up for questions on the floor. We're going to actually end at 9 rather than 9:15 because we have to be out of this room a little bit earlier than we had thought. So this will be about a 1-hour session, and then we'll go directly into the next session. Okay, great. Steve, you want to get us started?
Thanks, Steve. I want to thank Steve and Ed and Morris or whoever else is to blame for inflicting me upon you. So this is, from my perspective, a little bit of potpourri. I'm going to sort of jump around on a number of points that I picked up yesterday and a few that I thought we might want to think about. Of course, it's a cheap shot because you have to bound a conference like this. Housing risk is a huge subject, so some of them are just sort of placeholders for things we might want to think about. I have a bunch of slides, quite a few, but I'm going to race through most of them. They'll be posted online for anyone that wants to peruse them at greater length. I'm going to update them with a little bit of, some references and so on over the weekend. But of course, on the way over, I thought about the thing I'd been thinking last night would be my first slide, and then I somehow this morning when I got up early, I forgot to put it in, which was to comment on just a little side note on the mortgage proposal that Ed was talking about yesterday. There's always, it's not quite true, there's nothing new under the sun, but there have been a number of international programs that have subsidized mortgage buy-downs, some of them in developing countries. Probably the best known in the little subgroup of people who works on international housing finance is one that was done in Chile, started actually in the 80s, I believe. And like all programs, the devil was in the details. So I'll just sort of stop there and put a few references on some of that international experience that may be of interest to those thinking about the new mortgage designs. Okay, this is I'm not going to talk about, just that several times yesterday people talked about the home ownership rate, and because I have a slide for class that goes back to 1890, I thought anyone who wants to know can look at the slide at their leisure. The theme is risk, and so I thought I'd start with just a couple of quick comments, things that probably everybody already knows about risk in general. And while we can certainly, there's lots to discuss about this, it's worth remembering that one way or another, whether it's through good fortune, being smart, being, good people, whatever, we've reduced a lot of the risk in our economy. Of all the charts I dig up for students, this is the one that still kind of is in my top 5 of amazing charts, which is that GDP per capita growth on average, if you really take long run averages and strip out the business cycle completely, it's basically the average growth rate has barely changed in over a century. What has changed enormously is the volatility, is the risk. And of course, this led some of us to start writing papers about the great moderation just in time to see them circulate as working papers as our hubris was appropriately rewarded, in 2007, 8, 9, whatever. The old joke I use with students, what's a statistician? Someone who puts her head in the oven, her feet in the freezer, and says, on average, I'm comfortable. Punchline coming, then computes a confidence interval and is baffled. If we're thinking about housing, we can't just look at aggregate numbers, because housing is, basically not just arguably the largest or one of the largest assets in any economy, but it's also one of the most widely distributed. And if we're thinking about risk in the housing market, we have to, grapple with distributional issues as well as, the sort of usual macro aggregates. I hear a lot of people. I teach real estate. I interact with people in the real estate industry. I hear a lot of, especially young people, and even a few who should know better, whine about interest rates rising, we're all going to die. And to paraphrase Crocodile Dundee, that's not an interest rate spike. That's an interest rate spike. I'm not predicting this, and I have reasons why I wouldn't predict a 500 basis point increase in 1 year in nominal rates, but we've seen it before, and we should put our recent experience in perspective. I'm going to just skip over these. We look a lot at mortgage rates. People talked about mortgage rates a lot. In recent years, if there's one thing we've learned, it's that mortgage rates, economists like to think of prices as sufficient statistics. Interest rates are not sufficient statistics for the mortgage market, but damned if I know how to interpret capital flows, because talk about endogeneity, it's chicken and egg. So this is something we need to grapple with. If we're going to think about risk on the financial side, we have to look at a lot more than rates. There's been almost all the institutional discussion, at least the way I heard it, was about Fannie, Freddie, FHA, and to some extent VA. Just look at the dark blue line in the sort of 2003 to 2007 period. Private label played its role. And I think also my own prior is that there were some important interactions between private label and the GSEs. And if we don't talk about private label too, I think we're going to miss some of those lessons and stories. Another issue, and probably one that I don't need to rely on too much, is that I'm going to later make a few more comments about the idea that housing markets are local, but the idea that that means that you can basically diversify away risk with a naive version, emphasize naive version of the sort of risk models that our friends in finance generate. It wasn't just the recent, I put this up so that you just see the red line rising, and trust me, it's a reasonable measure of covariance among markets. And the basic story is this was not a black swan. We have seen increasing correlation among metro housing markets for years, and anyone who studied this seriously knew about it, and how we could have financial markets that, at least in some parts of it, were apparently pretending that we're fine because anything that happens bad in one market is going to be bailed out by diversification. Wasn't paying attention. I sort of started doing this after Morris. It's kind of my version of a Morris chart. Most of us, I have friends that if you want to drive crazy, in fact, drive me crazy a while ago, say you can forecast the housing market with a simple trend. Well, that puts me out of work. But on the other hand, a trend works reasonably well. The point is this last boom and bust, was quite different than we've seen in recent data. But rents haven't moved at all. That's an exaggeration. Rents are much, much smoother. A couple of people yesterday made points about rents, and there's a lot better rent data out there now, thanks partly to Paul Carrillo at GW, Dirk Early at Southeastern, and Ed Olson at Virginia. But my perception is a lot of people don't know about this data. I'll put a link in when I finalize this. You don't buy a house in the U.S., you buy it in a metro market. I don't think I need to elaborate on that after yesterday's discussion, but this is another thing that was not a black swan, something that I think came up a couple times in Ed's talk and a couple of other times. You have to look at the underlying assets, and regulatory and natural constraints are, among the supply side conditions that lead to increased volatility. And so, it's not a surprise that, if the city had the word sand in front of it, it was a very volatile market. There were a couple of anomalies that didn't quite fit this, but, this sort of natural constraint. We're not going to fill in, San Francisco Bay, but could we change development and land use regulations in California in ways that would basically smooth out the cycle somewhat? I think we could. I saved the geekiest part for last, and I only have about a minute, 1 minute. And so I'll just say on co-integration, read these slides and finish up with, we also haven't talked much, maybe we don't need to talk much about, disaster risks. And, lots of disaster risks we handle because as a nation, we are a giant insurance company for each other in many respects. But, what we should be asking is, what are the risks that might hit more than one market that would be a lot harder to deal with? So I'll stop there and hear what everyone else has to say.
Great, thanks, Steve. Joe Tracy.
Good morning. Let me also thank everyone for inviting me. I'm probably the only discussant will have to start with a disclaimer, which is that these are my own views and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. So one of the sort of new responsibilities for the Federal Reserve System is to, beyond our traditional dual mandate that you hear a lot about on stable prices and sort of maximum employment growth, is looking also at financial stability. I think it's a natural reaction to what we've been through with the financial crisis. And real estate clearly has been at the center of a lot of historical financial crises. So there's a lot of interest around the system in trying to understand going forward, can we get better metrics in terms of when we should be worried about real estate markets? And so getting at the heart of things like valuations relative to fundamentals. And I know that we've seen internally there's lots of diagnostics that will look at things like what are rents relative to prices? Are they getting out of alignment? One metric which I find useful, and it continues to need some development, and this is good for if we think a lot of the booms might be happening more in the newer cities that are surrounded by buildable land. So think of markets with fairly elastic supply curves, and this was the case that we went through, is to think about something more like a market to book. So this is the price of a house relative to sort of a replacement cost, because that long run supply curve should be basically at sort of a replacement cost. But what we need in this to do the calculation of the replacement cost ideally is like an agricultural value of land stripped out of any of the speculative sort of value. Some colleagues, Joe Jerko and Ed Glazier, they didn't have the agricultural value, so they did a shortcut. They said, well, let's just assume that land comprises a standard component or percentage of the overall cost. So obviously if land's getting more expensive, they're going to strip that out. And they calculated some examples of these price to replacement cost ratios for like Phoenix, Las Vegas, Atlanta, Miami. And now there's a lot of measurement error in this, but they found that for long periods of time, their calculated ratios meandered between like 1.1 and 0.9, fairly stable. And then we saw around 2003, 2004, these measures sort of march upward, reaching above 2.5 in some of these markets. Never before, and obviously when we saw the crash, we saw these ratios drop back down, in many cases actually falling below replacement costs, their estimate. These were also then the markets that investors who had cash and therefore weren't credit constrained probably saw a profit opportunity, that there would be mean reversion in prices, that the market had oversold. This overselling is probably a feature of the fact that we also saw phenomenal supply response to those very high prices. But once that supply is in place, it's there. And so when demand collapsed, prices probably over-adjusted. Then prices sort of moved back up into the range where in many of these markets it became profitable again to start building. And so we started to see, as we had expected, some moderation in the house prices going forward. Because now supply could come in both from building, but also people who had been underwater. Those price increases might have been putting them back into a position where they could sell. So it seemed like this is a useful diagnostic, at least for those markets where you think you have elastic supply, and we'd like to see, again, continued development to refine these. It's not a useful diagnostic to understand house prices in the Bay Area or in New York City. Another thing that is kind of a hot word is macroprudential tools, and you've heard some of folks around the Federal Reserve System saying things like, well, if it looks like some of these markets are getting overvalued, the first line of defense shouldn't necessarily be monetary policy or interest rate policy, but macroprudential tools. Some of that would come from supervision, and then some are things that we would have to sort of devise. And so there's an interesting question of, again, how do we get other early warning signs that there may be problems in real estate, and then what might be some macroprudential tools that could be used outside of changing something like the Fed funds rate, which would be a fairly blunt instrument. Some of the research that we did at the New York Fed showed that another feature of the boom cities was that there was a dramatic change in the composition of who was buying real estate during the boom, from individuals who were going to live in the homes to investors who were speculating. Now, if you looked at what people checked off on their mortgages, you wouldn't have seen this shift toward investors, because many investors had checked off that they planned to live in the home. But when we looked at the credit files and asked, how many first lien mortgages do you have on your credit file when you say you're going to be moving into this home, and looked at people with 2, 3, 4, 5, 10 first lien mortgages, we found that in fact the investor share in some of the boom cities reached 40 to 50% of the transaction volume. At the same time, of course, these investors want to use as much leverage as the lenders are willing to give them. They care more about not putting money in front as opposed to any interest rate, because they're going to flip the home. At least many of the investors were. And so I think also tracking, maybe through the credit files, this investor composition of buyers is a useful sort of metric. We're less worried about cash investors because they're not using the leverage. But the other thing that we observed was that leverage was pro-cyclical. And actually what we'd like is leverage to be counter-cyclical. We'd like a way that if it looks like housing markets are getting overvalued, that we take out some of the leverage. And then if price is correct, we actually allow a little bit of that leverage back in. And unfortunately, it goes the other way. Leverage went up during the boom, and then the pendulum swings the other way, which is where we are now, and leverage is perhaps too low. So if it's a natural phenomena that when markets are hot, that investors are coming in who are financing this with many liens, one of the things that we could entertain is a down payment policy which says that we have whatever we agree on as the down payment for a first lien. If this is going to be your second first lien, we increase the down payment on that one and progressively continue to increase the down payment requirement as someone is adding a third first lien, a fourth, a fifth. And this way, you would get, in some sense, naturally, this counter-cyclical leverage, because the investors would start coming in, buying many houses. That would start pushing down the aggregate leverage. And then we saw that the investors were also the first ones to exit the market when house prices started to turn, and that would naturally then shift the composition back to owner-occupants and therefore allow the leverage to rise up again a little bit. So one of the things that would be attractive if we could implement something like that is that it doesn't take the FSOC to make any determination that, yes, we need to do something. Because the worry always is if you're doing macroprudential interventions by committee is that determination is going to come too late. So it'd be nice to have some things that happen sort of in the background almost automatically that would help take out some of the risk in these markets. The thing that also impressed me when I was looking over the presentations yesterday is if we think not just a macroprudential, but I think now like if, from the standpoint of the individual home buyer and trying to make this a safer experience for them, it's the same conundrum that I faced when I was asked to think about for the first time housing back in my academic career at Columbia. And wondered the question that if I went into an investment advisor and said, I want to think about how much I should invest in housing, but think about it mainly from an investment standpoint. And here's the rest of my portfolio. And you would like them to say, well, what's going to be the expected return and risk to the individual house you're buying, and how is that correlated with like your income risk? You might think if you're in a one company town, that could be very high, and also with covariance with the other assets you're holding. And of course, trying to get the kind of data. Now, what I'd love to hold is a portfolio of all the homes in my metropolitan area. Then I could just look at the house price index for that area, but I'm holding an individual home. So understanding sort of how to get better metrics of kind of the individual house price risk, I think is very important, and it's not widely available. And I think this is very helpful then when people want to think about how risky is housing, and we've seen some of the downsides, especially given the leverage that borrowers take into that transaction. So let me stop there.
Great, thanks, Joe. Actually, that's a fantastic transition to Alan Weiss, who I'm sure is going to talk about measures of individual house price risk. So,
yeah. It's actually not necessary. Thank you. Thank you, Joe. We didn't actually talk before the session, I promise, but it sounds like we did because he just kind of, the transition is so natural to what I had intended to talk about anyway. So I guess when I think about risk in the housing market, I put it into two broad categories. There's information that can be used to help manage the risk, and then there's ways of helping people diversify their risk along the lines of a portfolio concept that Joe was just speaking about. So I'll first talk about information and then about means of diversifying and hedging. In terms of information, I stopped being involved when producing information about the housing market in 2002 when the original founders of Case-Shiller Weiss sold out the business. And I was kind of on the sidelines. And I felt good about hearing these indexes quoted in the news often as the boom was going on, and then I didn't really see it coming. I don't think anyone, not many people did in any case, when we would hear these indexes are still rising, maybe they're rising a little bit more slowly, but I think it tended to give people a naive sense that the overall market's okay. If the overall market's rising, then my house must be rising, and if I'm a lender or a policymaker, I assume that these wonderfully accurate numbers must apply across the board, so I can rest assured that everything is okay and everything is as it has been. And then the crash happened, and that troubled me because it seemed like these very same numbers that were so accurate and so well relied upon might have contributed to some degree to people's sense that everything was okay because these numbers must apply equally to all houses. And that motivated me to get back into thinking about how to measure home prices and how to forecast home prices as a way to deal with the underlying risk. And as I thought about this and I looked around, I noticed in my own town that there are houses that were worth more than $2 million, and there are houses that were worth less than $300,000. And at Case-Shiller-Weiss, the most precise index we had was defined by a geography, one zip code. And if we were lucky, we would have had one home price index for my hometown, even though there were houses that were separated by more than 10x. So I thought maybe the answer in having the information that was missing in the market that might have contributed to the boom and then the bubble and then the crash lies in not getting better macro information, but getting micro information and then thinking about how to roll it up into digestible ways. So what we did at my new company was figure out how to produce house price indexes that are just as accurate as the repeat sales indexes we produced at the ZIP and metro area, but at the house level. And we have completed that. We now have tens of millions of individual house price indexes using the repeat sales method, which sounds like a contradiction. The way we resolve that contradiction is when we were at Case-Shiller-Weiss, it never occurred to us that when we have a house, we have a lot more information than the zip code it's in. We know how the square feet of the house, we know the lot size, we know the year it was built. We know many things about that house for 100 million properties around the country. Therefore, we can draw a meaningful relationship between that house and hundreds of other houses nearby that have sold twice. So as long as we can weight those nearby houses according to their relationship to a given subject house, I can build a reliable repeat sales index on each subject house separately. And then with the wonders of cloud computing, and I can spin up 10,000 cores at the same time and wait a month, we can actually generate repeat sales indexes for individual houses, which we have now done, again, for tens of millions of individual houses. Now, when you look at that information compared to the roll-up of that into a metro area, it tells a very, very different story. And when I look back at what we could have known 18 months before the crash in any given metro area, it makes me shudder, and I feel there's a strong need to bring that information to policymakers, to lenders, all the way down to individual homeowners. And the key is to pay attention to the population of houses that are rising versus falling. And that can be a new headline number that is as easy to say as the metro area is rising or falling. But now what you've done is you've paid attention to the fact that really when you define a market, it's not just a geography. If you just talk about a market as a geography, you're missing something. Because as we were speaking about before the talk, if you have a house on the water, facing the water, and you have another house right behind it facing a dumpster, they're probably not subject to the same supply and demand characteristics, even though we at CSW would have said that's the same market. So as an example, we looked at San Diego. In 2004, virtually 100% of the houses were rising in value in San Diego. By 2005, it was 95%, and 2006, it was 40%. So during that entire run of time, the San Diego home price index was rising. And if people hadn't been paying attention, they would have felt that their entire market is rising. But I feel with this new number, we all would have been more aware and been able to take action. So I think these are important numbers. They can be used by any range of decision maker, from a home buyer, a home seller, a mortgage insurance company, a lender, anyone interested in trying to create stability in the housing market. And so now we now have dynamic maps on our website available to all that can replay the crash for you in major metro areas. And for example, in Southern California, we color code each house from dark green to dark red. Unfortunately, I don't have it here to show you, and this is monthly rate of change for each house. And you can see all dark green around 2005. And then you see San Diego starting to have sprinkles of light green and then gray and then pink and then red, and you see it crawl right up the coast. And you see all these green houses being traded right above that front, if you will, of declining home prices. And I think that if we had had this information and it was generally available, I don't think it would take more than a kind of a weather report kind of explanation for the average person to get what's going on. It's not very complicated. Then I think that what you would have seen the bubble be blunted, the crash be more muted, and therefore the devastation cut in half at least. So one of my goals is to get this information out there to everybody. Now, the other side of, I mentioned there's information and then there's risk management tools. In terms of risk management tools, once you can measure what an individual house is doing in terms of price, then it opens up a world of possibilities in terms of how to spread the risk. I think the other problem we have, one has been inadequate information. The other is that we have this binary way of thinking about home ownership. Either you're a renter or you're an owner, and you bear all the risk by yourself. As Joe is saying, that is a really bad way to manage your portfolio. And what we've done is we've maximized the risk by focusing each individual house and making it reliant on one person to be able to continue to finance that. That's crazy. We've got to get away from this binary thinking that the solutions are either completely rent or completely own and bear the risk yourself. It ought to be possible to have a continuum of choices between those two once you can measure home price risk accurately. Look, if you contrast the housing market to the stock market, there's a lot of interesting comparisons. They're both roughly the same size. The amount of research put into the stock market is immense compared to the housing market. And if you think of the units of investment, there's tens of millions of houses. Thank you. 1 minute left. I got it. Tens of millions of houses compared to thousands of shares of stock, which are all the same. And look at how many risk management tools are available to capital markets investors. Puts and calls and shorting and going long and hundreds of different risk management tools compared to zero for the average homeowner. And the average homeowner is highly leveraged, has more than their entire net worth in their house. If you were to, as you said, if you were to be advising them on having a diversified portfolio, you would maybe say you should have 10% in the housing market overall, let alone 10x your net worth in one house. So I hope in the future, with better information and now this mindset that we've been painfully made aware of the risk that we all bear together in placing people in these precarious positions, that there can finally be some innovation in terms of widening out this continuum from two binary choices, which are okay, but many people need to be somewhere in the middle.
Well, thank you very much, Alan. Well, 3 really interesting presentations. I have a lot of questions myself, but I'm going to hold back so that the audience can ask questions. We have about 20 minutes or so, so just raise your hand if you've got a question you'd like to ask for any of the panelists. Morris?
So something no one mentioned, I don't think, is policy risk. And the vision, I think we heard yesterday that for what we think good policy would be low housing prices with low appreciation, where the young can afford to buy a nice house with a significant down payment, and where they build wealth through paying down their mortgage. And that would give a society with low leverage and then less financial risk, less risk of another financial catastrophe. Instead, current housing policy seems geared towards lots of leverage and building wealth through appreciation and speculation. I was wondering, Joe brought it up briefly with macroprudential policy, but none of you touched on maybe policy risk in the housing markets. Does anyone have anything to say?
It's a Pandora's box to start going into details, but one of the taglines you've heard from me before is, in my international work, a colleague and I long ago decided that every country really only has 2 housing problems. Housing prices aren't rising fast enough, and housing prices are rising too fast. Every country has these problems simultaneously. Once we fix both of them, everything else falls into place. So there is it's a complicated box, and there is a lot of tension, if not a knife edge, trying to find which way you go. But I'll just, other than that, I'm not sure how I can give a quick answer.
I have a suggestion. Right now, if you want to own a house with a partner who can bear the equity risk with you, I don't believe there's a mortgage in the country you could get unless that partner were an individual. Because when I try to do this, I call up my banker, I ask, what's the policy? They say, well, the Fannie Mae policy is that the only person you can own a house with and get a Fannie Mae mortgage is they have to be an individual. They cannot be any kind of institution or company. So if I could change one policy, I would say allow for a conforming loan that enables two equity holders of the house. And those parties together can get a loan. Then you have the opportunity to form any deal you want between the owner-occupant and the equity investor, including the equity investor absorbing X% of any decline, thereby placing the homeowner in the mindset that they retain equity, which we know is the biggest driver of their willingness to keep paying. So you stabilize the system, protect the lender by allowing this policy. This particular policy makes almost any innovation impossible. I'm working on it anyway, but if I could change one, I don't see any reason why that shouldn't be changed.
Joe?
I'd like to second that. Some colleagues of mine, we wrote about this issue. We called it housing partnerships in the 1980s, well before the subprime, which was kind of trying to make housing affordable by going the other direction, which is taking on more debt. Oftentimes, people ask me, you're an economist. You say that in these housing markets, prices got way above fundamentals, and that was the problem. Why didn't prices work? Aren't prices supposed to prevent that, like actually ration the market? So what's wrong with the economics? And I said, well, the economics, I believe, is fine. It's the housing policy response, which is as prices are rising faster than the fundamentals, let's say income, what's the natural response? Housing is becoming unaffordable. This is really terrible. We can't allow this, right? Because people can't afford homes. So what we're going to do, obviously we're not going to raise their income. We're going to relax the underwriting standards to make it possible to offset that price increase. Well, that works for a while, but then if prices continue to rise, housing is again unaffordable. So what do? Well, we don't want housing prices to actually ration the market because that means people can't afford homes. So let's further relax the underwriting standard. At some point, we can't relax anymore, and that's when prices start to do their job. And then people say, well, this is terrible. Look what's happened. And so I think there's this inherent problem with the policy, which is we really want prices to ration the market, but we don't. And we need at some point to get policy to be more steady and then allow the prices to also do part of their job.
In the back, and then Tom. Can you wait for the microphone? Pardon? Wait for the microphone, please.
Hi, I'm Carol Plasek. I'm with Treasury. One characteristic that has provoked price volatility is that every time you buy a new home, you're subject to whatever the interest rate is at the time. With a concept like a portable mortgage, where you would simply recollateralize your loan, that should take out some of the volatility. Since the majority of buyers are move-up buyers, they could carry their base loan with them and simply do an add-on with a wrap. What's your reaction to that?
Anyone?
Well, one of the policy responses to the decline in house prices, at the same time we saw mortgage rates go down with the accommodative monetary policy, but a number of people who had fixed rate mortgages couldn't take advantage of that by refinancing. And so we had programs like the HARP program, which seem entirely like an appropriate response to get around this friction to allow the transmission of those lower rates. But at the same time, I was warning people. I said, we need to understand, go with eyes wide open. We are putting people in historically low 30-year fixed rate mortgages. At some point, the economy will be in a position where we will, the Fed will normalize rates, and rates will rise. That the cash benefit of having them refinance into these low interest rate mortgages is going to turn into a penalty if they decide to move. So these people better be where you want them to be, because they're not going to be moving or selling. And this is a function of the mortgage design, to get back to what Alan was saying. So if, now in FHA, it's portable. So we said, why don't we think about making these HARP loans either portable or assumable? But of course, we just copied over exactly the standard loan. So I do think we've built in the mobility problem going forward as rates rise. And it just underscores we should be a little more creative, I think, in the design. There's so many dimensions that we could improve the design of the underlying financing.
I would also add, which kind of is a combination answer to both of the questions, that the reason prices can get out of whack is the combination of the individual wanting to live in a home for consumption reasons, and lenders not paying attention to being willing to lend on the sort of article of faith that prices don't go down. If the lenders simply said, these prices don't make sense because we can see that it's a bubble, if the financing dried up, then the prices wouldn't get out of whack. It's the inefficiency in my mind of the lending policy that's willing to finance a person who's in effect renting the house that causes the problem. The prices simply wouldn't be bid up if no one could get a mortgage in that area for the right reasons at that price. However, if the lender said, I won't lend $200,000 on that house, but I will lend $150,000, what's going to happen? That house can't sell for much more than $150,000. The problem is the lender is validating the market and feeding into the incorrect price.
I think Tom Lamalfa's next.
Thank you and good morning. My question has to do with the role of housing policy in the financial crisis. Was it a paramount precipitator, if you will? And are we currently at a point in time where there's too much government in housing? Curious as to each of your thoughts on that.
And anybody jump in.
That's another somewhat large question. I would say we spend a lot of money very ineffectively. Mortgage interest deduction would be a starting point. You know, I think moving away from supply side programs like the low-income housing tax credit program and more into vouchers is an appropriate way to proceed, and we have a lot of research, I think, that backs that up. On financial policy, I have some thoughts, but I think I've got a couple of colleagues who know more about that than I do. But short answer is, sure, there's a lot we can do in this to improve our housing policies, both at starting at the national level and drilling down from there.
Well, I'd say a couple of things. One, again, is this question of who should be bearing the house price risk. So I heard a number of times as the housing bust was unfolding, people comment, if we just had full recourse lending, we wouldn't be in this situation. And that's the problem, is that, these homeowners can walk away. And I said, so what you're saying is if it's absolutely impossible for the individual borrower not to bear all the house price risk, things would be better. Is that really, from a macro-prudential standpoint, who we want bearing all of that house price risk? So it goes back to Alan's point. I'm guessing there's going to be lots of bad unintended consequences if we decided to go there. We've seen this in other historical periods. So then if we shift to the other end of the spectrum, the debate was going on, obviously, around GSE reform, which is who should bear the systemic risk at the macro level in housing. And people saying, the government is terrible at this. It should walk away from it. It should promise to never, ever get involved in taking on that kind of risk. And when we thought about this, we said, is that really, if it sounds good, I suppose, but is it credible? I think the government owns the systemic risk in housing. It's too important of a market. And even if they said they don't, if things get bad enough, they're going to step in. Well, if that's the case, then we're back to an implicit, guarantee. Why don't we just own up to it? Would it be better to say, yes, the government owns the tail risk in housing, but we're going to define it in a sensible way, we're going to try to charge for that. This is a question of should they have an explicit premium. So I do think there is an important debate, even though GSE reform is kind of stalled, thinking about also the macro risk and how should we be allocating that, as well as the individual risk, and how could we help homeowners diversify that.
So the question was about, is there too much government in the housing market? I would say yes in two ways. FHA loans I find very frightening because now we're back to nearly 100% or 100% LTV loans. So there's too much money, I would say, from the government in the housing market. As I said earlier, I also think there's too much regulation, and that bears on this question about bearing risk. What's funny about this conversation is we're only talking about the risk. There are billions of dollars now pouring into the housing market from private funds. Blackstone, these REITs that buy houses now as an asset class and rent them out, they perceive opportunity in the upside. And I think the problem is we're bifurcating the world, and that we've got two different groups talking about two different things. You've got nearly an infinite amount of capital seeking to get into the housing market, and then you've got nearly an infinite amount of risk, and we're trying to figure out who should bear it. If those two could be merged, and you could have private money participate in the market, all markets have opportunity and risk, then all that capital which can handle the risk would pour into the other side, and we would then even out the playing field, and the money that can bear the risk would do so because they can also enjoy the upside, thereby siphoning the risk away from the public. I mean, the government doesn't really bear the risk of the stock market because investors are willing to be in the stock market because of the opportunity. So we got to merge opportunity and risk, and then I think the market will take care of itself much better.
Right. You and then Joan, yes. And I think those might be our last two questions.
Okay, this is Tom Showalter.
Yes.
Regarding the bearing of risk, one of the things I've noticed about a comparison between the equity market and the mortgage market, especially mortgage securities, is the information infrastructure. Information infrastructure in the equity market is huge. You can find out anything about any publicly traded company anytime you want, even at 3 in the morning. You buy a mortgage security, point to a loan in there, try to find out whose loan that is, what house that relates to, and what market it's in. You can't. So I would suggest one of the problems is the fact that the information infrastructure supporting the trading of mortgage securities and the trading of mortgages, we trade more money on weaker information than any other company, any other country, any other market in the world. That's not a good idea.
Yeah, I agree with that. I was just thinking before this conversation began, what would the fraction look like if you compared the dollars invested in tracking a market divided by the number of units investable, mainly shares and stocks. So you've got, maybe 10,000 different units of stock that matter, and then the numerator is how many dollars are invested in that. Now go over to the housing market where the denominator is 50 million different units and how many dollars are being invested. Something's wrong here, and I agree with that. One way that's being addressed is a project I'm involved in to identify the house in every single mortgage-backed security and apply risk metrics to every house, because you don't care about the average. Once again, you care about the total dollars at risk added up on a house-by-house basis. Not if I can't swim.
Joan, did you have a question?
Joan Trice, Collateral Risk Network. One of the overriding themes throughout the whole conference has been access to data, and all the inputs that I'm hearing about generally are sale price, not value, which are not synonymous. And as an experience as a real estate appraiser, they often diverge, and I think that's indeed part of the risk that we just went through. How do you solve the fact that we are dealing with a black box? We don't have a real estate superhighway. We don't have a scalable system that is different not only state to state, but 3,600 counties have different degrees of data with integrity. Don't we need to start there? We can't measure really anything accurately if we don't know the integrity of the data.
No, I'm in agreement. I think we have to be realistic. We're not going to change, the county-based system. So the question is, what can we improve and still work on it? We have a group at the New York Fed that is our legal group that are working on sort of thinking through how might we set up, say, a true national registry. It's going to probably have to involve some, changes in laws. We'd love to also get rid of paper. We should be going full electronic documentation, moving to things like I'm involved on the legal entity identifier, international work for entities that transact. We should have a unique mortgage identifier. We should be stipulating, what are the minimum data fields that are required, and then provide in some way that full transparency. What's interesting as we talk to people is that it's a difficult problem, but it's not something where we need to wait for some new innovation to be able to solve. It really is taking existing technologies and just having the will to let's get this done. We need to bring mortgage finance, the infrastructure, maybe not even up to the current century, but maybe up to like last century even. And I tell people, we're not going to be able to crowd back in capital, which was the thought with with incremental GSE reform, just by raising G fees and lowering conforming loan limits, because we haven't fixed what some of the fundamental problems were with that market. And part of it is exactly this issue. It is fixable. It's going to take an enormous effort, but I think we have to get there for the future.
Sure, yeah, follow up, please.
Could I answer the previous question? Sorry. Just to add to that, there are private databases that compile public record data across the country that have 100 million plus properties and 250 million transactions. The answer of value is hidden in that information. Yes, they are prices, but if you can analyze it well and not only pinpoint what the market is saying about the value today, but look at the trends around it, I believe you can arrive at intrinsic value and sustainable value. It's a matter of teasing out the trends that are hidden in this immense database.
Tom?
This is Tom. One last question. I agree that the information's there and the trends are there. My question is, how are you going to get that information in very granular form from where it is to the investors in the secondary market? Because right now, the issuers of securities like having the information advantage over the investor, and that concerns me.
Okay, so we just formed a strategic alliance with Kroll Bond Rating Agency, and I've also had a lot of conversations with hedge funds who trade residential mortgage-backed securities. There are ways of going into each security and tying it back to each house, and then analyzing the current intrinsic value of each house measured against that house's loan balance, intrinsic value, not just price, and forecast that and do a much better job than it's done today. There are people making a lot of money doing this privately, but I think this can be made available to everybody going forward in all of these securities, and I believe that's going to be happening.
And just maybe one footnote to keep in mind, one of the things that provides tremendous liquidity in the market right now is the ability to sell forward. This is the to be announced or TBA market, but that's the cheapest to deliver. So one of the things we'll have to work out is both wanting to provide a lot more information, even down to the actual loan level, and also trying to preserve the TBA market. So it may also be an issue of when is the information provided, not just what information is provided, because I think we want to be careful before we do something that might end up undermining the TBA market and its liquidity if we can preserve it.
Great. Thank you very much. We're out of time for this panel. Please join me in thanking our three panelists. And we'll move directly to our next panel, which is on multifamily housing.